Good evening, guys. Ken at Tortoise Capital. Saturday Night Strategy Podcast, February 18th, 2023. So we're looking at some swing trades. Start as always with the RL30 slope, the Z score of critical sectors, and we're looking at the important boundaries between plus and minus 1, which is at band of normal, around the zero line. So anything north or south of that is where it becomes abnormal. So we just experienced a nice run up that has become weaker this week and has come back into the S&P has come back into the zero line. We notice that tech is still above average, and that's good, but it has been slowing. And the former leaders, energy, materials, and finance, all have started to decay even further and really could not get above the plus 1 line. So a move by those back to the minus 1 would not be unusual. So don't be surprised if we see more weakness in those sectors. And then the question is there enough juice in tech to help turn the S&P around? So that's why in last night's discussion of the situation, we took a look at this as a very important turning point for the intermediate trade, which really influences our swing trade. In the world of conservative versus aggressive, we have, you notice the S&P has rolled again back under the plus 1. XLY, which is the consumer discretionary, peaked up around Z plus 2, which really capped this nice really run up. That was a strong move on discretionary in tech and in the market, which is decaying. And then these staples, XLP, have really not improved much at all. So this almost looks like a tech-fueled rally and a growth-fueled rally, and the rest of the market did not really accompany it. In fact, we saw weakness in XLU and healthcare. So this was only a partial market victory in here. So that's why this is still an important tactical turning point. So no change there. Let's take a look at Charles has a. Here he is, CDW. So Charles has given us a triple time frame screen on CDW, and he's given us the weekly, daily, and 65-minute, or the hourly view. Excuse me. And you can see that this on the daily, this little pullback to the PSAR and hold was followed by a second leg up, and it is pushing this all-time high. And so really there is no resistance overhead. So there's nothing that stops this from going. It has cleared the last two levels of support around 200 and 202 convincingly. This little move above the previous peak of the RL10 was just the beginning of the Z channel expansion. This is an example of a Z score compression in the Bollinger Band mean that finds support, a PSAR flip. The first leg gets you to the edge of the Z3 pinch, and then when that does not fail but breaks out, then you get that second leg. It's almost like the tension has been released in the spring, and you get this move, and then this move is really the same height. So the argument now is, now that this is here, where? Well, there was no selling pressure in here whatsoever. None of that happened. And so you could take the position, I want a very tight stop at the edge of the PSAR or at the previous RL10 peak or the belly of the dragon or the belly of the RL10. So you would pick one of those four positions to be the price that would make you believe that this trend is no longer working. So if this goes above 215, for example, then this is an all-time high, and you would say, well, who that owns it is going to sell it? Nobody, as long as it stays above 215. So if it breaks out above 215, then you have evidence that there's more buying pressure coming in. All right, but what if that buying pressure fails? And what happens if it starts to collapse? Which one of these price levels would you take to be evidence that the buying pressure has reverted to selling pressure? What do we mean by selling pressure? Well, by selling pressure, I mean that all of the folks who bought in these regions are now more concerned about preserving the money that they've made than hoping to hold on for more money. Now, that's a harder sell when it's above its all-time high, because now you're only dealing with people that are trying to preserve profit as opposed to people who have a firm conviction that it's overpriced and are pushing it down, just like in the past. No, because this is all free and clear. So now what you have to do is if you're going to take that trade, as Charles has framed it, you got to decide which of those four price levels represents the amount of R give back that would persuade you that this move is over. So then you would use that as the disconfirming price level, the adverse price action that disproves the hypothesis. And then you would position size off of that. So to me, for a swing trade, we could, we're going to start with, well, there's the size of the daily bars. So if you want a swing trade and you want to sort of protect against routine adverse gaps, you want something that's more than one average range. So to me, probably 208 is a reasonable place. And then you could say, well, that would lead me with a $7 risk. Do I have a belief that there's $14 above? Well, if you would just do this, measure that from 192 to 202 is a $10 move. This move from 196 to 212 is a $16 move. So a $14 move north of 215 is not irrational. So there's a reasonable sized excursion available. I mean, this move on the daily, for instance, was, even if you go from the PSAR flip, 180 to 200. That's a $20 move in that swing. If you start it from edge to edge, that's 175. It's 25. So a $14 move is not irrational. Here's a move from 195 to 215. That's a $20 move. So a breakout from here, saying that there's $14 available, is not irrational. So you could actually afford a $7 swing risk, and play for the swing trade just with overnight risk with a $7 risk. So if that were my core position and I was using the $7 risk, let me pull up TC2000 real quick. Let's see if we can do a little math on this. Hopefully it's an S&P 500. CDW. There it is. Isn't that a beauty? So just pause for a moment to appreciate the fireworks pattern You have a 150-day low, 150-day high, which is also the 10-day high. Here's your 10-day range. It's at the top of that. Here's your 30-day range. It's at the top of that. That's good. Here's your 150-day range. So this is a popcorn explosion type of a move. If I come over here and look at CDW then, just get his quick stats. The range stat on this thing is $5.47. So call it 550 is the R stat. So that means if I'm using a $7 risk, it takes an abnormally large one-day move to kick me out of the position. So at a swing trade basis, that seems reasonable. So if I'm getting long at 215, minus 7 is 208. I'm probably down around here. That would be the risk of that swing trade. And then that would work. Then I could look at this as a turbo and say CDW has a R10 of 55 cents. So call it 50 cents for the intraday move. And now if I just take a look at what kind of intraday moves this thing gives, just using the 30-minute bar, that is about as orderly a move as you want. I mean, gee whiz. So you could actually frame this one with a breakout above, say, 215. Sorry, I meant to do that in green. So if I wanted to say, I need to see a move above this peak RL10, that would be the emerging dragon entry. So just using the daily risk, the daily bar, you might be willing just to go a $3 risk. I mean, what if this thing priced out and did this? It opened here, you got long, and then it immediately started to fail. Would you let it, how much further below that would you let it go? The $7 risk at 208 is all the way down to here, which is the belly of the dragon as we saw before. So I'd be comfortable on an intraday basis if I was trying to do a turbo trade. Just use a $3 risk on a 30-minute bar. Take that entry, and then don't suffer more than a $3 loss, which means if I position size against a $7 risk, that's a minus 0.4 on a swing trade position. But you could actually just start that off as your swing trade entry, cap your loss to 0.4, and then if it closes well, you'd be all right. Now, what you could also do with a $3 risk, you could then come down and look at and say 50-cent risk. Now, if I was doing this at turbo on the 3-minute chart, this thing actually has some reasonably fluid moves. I might be willing intraday to do something like this. This is where core and turbo really comes into play. So 215 would be my mechanical swing entry. And on that one, if I was just using daily bars, my stop is down here, way down here at 208, a $7 risk. But if I'm using the 30-minute, we said it was 212, which is approximately here, right? That could be the turbo exit on the 30-minute chart. So I'm only risking $3. But I might be willing on a 3-minute chart is to say a breakout above 214. Like if it opened here and started to move up, I could take an entry at 214 or 214 and a quarter, and then just come over here and look at my MMRB, 55 cents, call it 60 cents, I don't care, 50 cents, and then say from 214 or 214.50 and just say, look, I'll just play it with a 50-cent risk, and I could take 4 times the swing position size on a 50-cent risk. So let's say I was going to risk $400, just for the sake of argument. If I had a $7 risk, then that means I've got 57 shares. A $3 risk, I'm at 133 shares. A 50-cent risk, I'm at 800 shares. So maybe I could do a 500 share entry. I could do 500 shares on 50-cent risk is $250 of the 400, but I could buy 500 shares here. And then if it never went below this line and then went up through my swing, dude, you would already have, at the moment you were ready to put on a swing trade with a $7 risk on 57 shares, you would have made 50 cents on 250 shares for $125. And then on a $7 risk, you've paid for 3/4 of your swing position just by virtue of having used a turbo entry in this tactical space. So you could reduce your risk even further and then just leave 50 shares, call it 50 shares, leave 50 shares on and just let it go with a $7 risk, and basically, or even a $3 risk, and basically your swing trade risk is paid for with the money that you made on the turbo, and then you could leave it alone. So this is the idea behind a 3-minute, 30-minute, daily, 3-day hybrid swing trading, where you're looking at very turbo and very swing. So this 30-minute to me is kind of the nice balancing point between the 3-minute and the daily, because you can manage a lot of trades in there. You have plenty of time to think about it. You get some very favorable, manageable reward to risks, and all of that is kind of supported by using the range stat as a start point for your overnight risk, and then the R10 as your intraday smallest risk box. And then you can tell just by inspection if this thing is an orderly trader, and CDW seems to be an orderly trader. All right, so let me stop there and see if anybody has any questions about that. That making sense to you? Okay. Let's go back to personal. All right, so thanks to Charles for the CDW. What's interesting is CDW is his initials as well. Charles Williamson, so life imitating art. All right, let's take a look at Dan's. So this is nice. This is a perfect, looks like a perfectly executed, whoops, sorry about that. My screen went wild on me there. So this is U.S. Steel on 3 minutes. So this is the very turbo portion. Here was the open. Here was the gap down. He gets an MMRB, takes the short. That looks almost like 2R. And so he cashes 80% of the turbo. Now, what I don't know, does that mean you kept 20% as a swing with an entry of 29.40? So he's treating that as a swing short. Okay, got it. Now, the reason that you are trading that as a short is why? Is there a reason to believe that that a signal at 20, call that 2950, was that actually a signal that says this thing has an overnight swing pattern was triggered? Is that why? Is that why we
Uh,
want to be short from there? Because
uh,
otherwise, you would say, I don't want to just because I experienced a 2-hour win on 3-minute charts doesn't qualify that as a overnight swing trade necessarily.
I think there was uh, room under that blue line. That was a daily resistance line
Okay, all right. So
or
this was
daily support line. I think there was room under that, that if the market kept going down,
yeah, I think you're right. So
yeah,
this
that
is
was.
what I would do on that if I were you is look at turning the and I started doing that on the market health check is putting the daily mechanical entry as a green line and then the daily mechanical short, which is like 5 cents below yesterday's low. And so that tells me that this distance in here is the yellow zone or yesterday's range, right? That, this is yesterday's range. So in that case, being able to get short in here and then cash it right here, you're cashing it below the swing or the swing trade mechanical one. So that's actually that's a legitimate pattern. So that would be my guidance. It makes it easier to see what those price levels are when you start flipping around between time frames. So that's just a thought. All right. So this is, oops. Um, which day? Let me see what day that swing was here. So this turbo swing was on. Okay, so the 17th.
Friday. Yeah, it was
All
Friday.
right, all right. So I'm gonna just trying to lock in my my play here.
You can also see it on the one of the other charts I had where I
Yep.
show it
God dang it.
as a swing trade.
Yeah. So we're looking at the now. It's now my tablet's not letting me draw worth of crap here. Hold on. All right. So this is the 17th starting here. Okay. I just wanted to get situated on the chart when I flip. Okay. So this is now. So here's this.
You can
Okay.
see the
I
same
got it.
trade
Yep.
there.
Got it. Got it. Yep.
Yeah, on the 17th.
So here's the 17th. So that's what that. So this looks like. Was this the first entry short, or was this the entry short here?
That one.
Okay, so that was the short entry because
That
of
was
this gap
the
down.
short turbo, and then the
Yeah.
second red one is the. I thought of the second red one as the swing entry.
Okay, so that's got it. That's the swing entry, and yeah, because this looks like. Well, this may have been. See, I'm trying to see where that blue line. That blue line looks like the. I'm not sure why that is a signal because here's the 16th. Yeah, so that's that. That's almost like a collapsing dragon signal. That blue line. So I would just be a little. I would be careful about what those lines mean. Boy, this my little sketcher's not really working with me here. Getting intermittent. Okay, so that's the decision to swing. And now what is this green face?
That's where I exited the swing trade.
Is that the swing? And that was just so that's really an intraday trade because there's nothing, on the daily bar there would be no reason to get out there because your
No, it
swing.
may have been a premature exit. I,
Well, that
I
well, that's getting ready to get close. It comes back and touches the VWAP. I see that.
yeah, I was nervous. The market was starting to
Yeah,
turn around
yeah.
after that
So,
deep sell
so
off in the morning.
yeah, so that's why the point here is that the intraday moves are different than signals on daily charts because really, on a swing trade, if I'm getting short here, then I got to decide what is the exit that tells me that that swing trade short is no longer working. Technically, it's the PSAR flip up here or the dragon.
Yeah.
So
So
so this
I'm tracking the PSAR flip exit as well as my with all these trades, I'm tracking both one discretionary exit
yeah,
and the PSAR flip exit.
yeah.
So I'm
So
tracking them both. I happen to have taken the discretionary exit on this
yeah,
one, and I may have been getting confused between intraday and swing thinking because I'm, such an
right.
amateur at turbo
Yeah.
trading still.
Yeah. So the idea is that my swing trading position, based on the overnight risk that I'm taking, is that thick black line. All right. And your entry was here. So the swing trade risk is from 30.29 to 28.83, which is 17. That's about $1.50. So your swing trade risk, that's this red line here.
Yeah, the R stat was
That's $1.50,
that's the R stat for U.S. Steel.
which is
About
amazingly how often that is the case. So that
yeah.
actually is a nice one. So really, you felt pretty good about this entry right here, and then based on intraday action, you decide to terminate the swing trade here. And so the difference. So just notice how insidious our little rat brain is. From here to here, we were feeling great. And then just an adverse move to here was reason to get out. So it's really just that much, which is about 40 cents. So a quarter of an R of adverse move intraday caused you to terminate the swing.
I was
Whereas
using I was using the R3
for
as the
the
swing stop, not the whole
okay,
R
well,
stat. Yeah,
all right,
but
okay,
still, it was a
yeah,
kind of a rat brain exit. I
yeah.
agree with you.
So my point would be is if you're position sizing off of this, that actually that's not even 40 cents. That's maybe more like 30 cents. That's about 30 cents. That's about a 0.2. So an intraday adverse 0.2, you're trailing with a 0.2 stop. My only point on all that is that this is really noise. Like it's not even to the Z3 pinch yet. And I want to just illustrate a point here. So from this blue, this is where the middle of the Bollinger Band is, and then here is Z2 and Z3 from the moment of the pinch. So this thing never even got to the edge of the Z3 channel when it was at its most narrow, and so you're exiting inside noise. That if you're going to risk that money and use $1.50, what that little preservation did was made you miss 3 times of a routine move just intraday. So I think a 30-cent adverse move is probably too tight. Because if you're doing that, now you are essentially day trading. And if you're going to do that, you probably need to be on the 3 minute and just day trade it if you're going to do that. But I don't think that's what you want to do. So what I would say is if you've got $1.50, trail it with $1.50. or trust the skin of the dragon, or trust the PSAR. And that lets you stay in this trade at least to here by the end of the day. And then over in here, make a decision if you want to hold it overnight, because this entire move on day one is uh, is when the market's open, and so you could or trail it with a half an hour, or use the skin of the dragon or something, stay in that trade, and then in the last 20 or 30 minutes decide, all right, is this enough of a gain? You made that much gain on the first day of a trade where you were taking this much risk. Do you see that?
Yeah.
So you're holding going into the long weekend probably zero point 0.6 on your swing trade. Now, it's a long weekend, and this is coming into a crucial support level back here, and you got most of the move. That would be a candidate to me to say, you know what, I'm just going to take it as a one-day intraday trade, and in the last 30 minutes decide to get out somewhere around in here and call it a day and take 0.6. And then next week on Tuesday, if this thing continues to break down below, I know that any price that gets below this red line or this blue line here, I think you got it, is going to be a strong signal for a swing continuation. But then I don't have to, if I just get out here, I don't have to take any over the weekend risk. And I can just re-enter with a turbo in here.
Yeah, that makes a lot of sense. Thank you.
So I would just say learning how to play the time between 3 minutes, 30 minutes, and then the daily is kind of crucial. The 30-minute allows you to get a head start on what's going to be daily trends. But at the end of the day, the difference between those two prices is that the daily decision has to include ideas of the gap. But you're setting up that trade on the basis of the 30-minute chart and the daily chart, but you're making decisions on a 3-minute chart to quickly see what looks like signal on a 3-minute is just noise to a 30-minute. Because this was the 30-minute risk on the PSAR flip. And you were already below this PSAR flips in here. The next PSAR flip never occurred historically till down here. So there's every reason to believe it can get that far. Okay. So that's what I would say on that one. Enough on that.
Yeah, good points. Thank you.
Okay, so now on Alcoa. This is one where I might suggest, just in terms of readability on the chart, see how compressed all this price action is in here? And there's all this unused space.
Make it wider? Okay,
I might just expand the aperture so that you can see those moves a little more clear, because otherwise you have to put your bifocals on to see if there's anything going on in here. Let's see. So let me take a look at what's going on here. So did this happen at the open on the 14th?
Correct. Yeah, I opened it short. And
yeah. So this gap down and then immediately reversed.
Yeah, a gap down. I entered short and then it reversed. So within 20 minutes, I was out, stopped out.
Yeah. Now, if this is a swing entry, is that a swing entry?
It is. I was using basically the PSAR. I think it was something like the R3 for a stop, for a minimum.
Yeah. So R3 is that's an intraday stop, by the way. because
Um,
that's 1/3 of a range stat.
yes,
So that's
exactly.
so just remember, that a range stat is an average range plus one standard deviation. So if you so that would be this size of move from 0 up to a range stat. So if you take a third of that, that's a noise box. That's an intraday noise box that you're using for the swing trade. So the better one to use is either the R stat or 2 times ATR for position sizing. Now, on as a as the widest range. Now, if I'm getting short here, to me, at a minimum, yeah, I don't mind what I'm going to say. I don't mind the Bollinger Band mean as a trigger because that's a PSAR flip. That's a reasonable way to get that thing started. That if this really is going to be a breakdown, I wouldn't expect it to come back up in here and then fail again. On the other hand, you could say, hey, the far side of Z3, because that's 47.31 to 50. That's $2.50. That size of a wrist box is $2.50. And if you use that, the fact that it didn't fail all the way through here and price came back up, and you're going to end up taking that exit right there anyway. So I don't have any grief with that, except I'm going to say that shouldn't be more than 1R because your 1R should be up in here. That should have been
Mm.
about a point 0.4 in terms of failed effort, right? Now, if you do that and it doesn't fail, now you're noticing, if you're using our method here, that what pattern is that starting to look like?
Kata 2.
Yeah, yeah, right in here. And then there's your PSAR flip with a wrist box right here. And you won't lose money on that one until it gaps against you. And this is the point I want to make about when you're incorporating intraday boxes, you're using small boxes, and then routine gaps like this just smash you. But that never, and that's the size of a Z3 to Z3 pinch. So my only point on all this is that we should never be taking on on intraday reversals. We shouldn't be taking more than 1R losses on the swing trade. Let me see if I can find. This was what Alcoa. See if I have the ATR on this thing. Yeah, so the range stat on Alcoa is 3.25. So I just want to draw that on there for a second. So on this one, if you're just using the range stat, which is a the average range plus one standard deviation short, for so three don't what did I say 330?
325, yeah, I
Yeah,
think, or
325.
three
So that would be
330, yeah.
50-50. That should be 1R. That's an aggressive 1R on the swing. That size of a wrist box. So if you got short here and then you elected to take that one for good reason, that should be about 0.4. And then on this one, you know, getting long at 50, so minus 3.25 is 46.75. Yeah, so your 1R is about here.
Yeah, I wouldn't have had the
Yeah. So
1.73
so
R loss.
so that was a significant. I mean, that was a significant adverse gap.
Yeah.
And then you're only taking instead of a I'm sorry 1.7 R loss, you're taking about a 0.6, and so your mental mind state is much better. You can actually take that one short. I ended up doing that. If you take a look at the daily debriefing.
Yeah, no, I saw you talk
Yeah,
about that
yeah,
Friday. In fact, what I realized was, and you see, I have a note here that I missed the better exit at the end of the day.
yeah,
I really should have never held that one overnight after it was getting ready to flip the PSAR
yeah. So now
on
so
that
what you can
final
do though
closing
on this
bar.
one is if you looked at this one as a swing and you were taking that kind of intraday risk and you had this kind of a bump up and then it started selling off, you're already thinking about cashing some of the intraday money to fund the risk of the overnight gap, and then the size of the overnight position is much smaller. So the advantage of trading it on the intraday on 30 minutes is that you could use the point 0.3 of a range stat as long as you were, aggressively cashing wins at the end of the day. So
And
I would just I would
I've been
spend some
doing
time on
that,
that.
but
Yeah.
yeah, I've been doing that, but I haven't. Um, uh, I've been reducing the number of trades I hold overnight. Um, but I think your way is better. I think I'll take that under advisement for sure.
Yeah, I would
And
add the size of the ATR and then kind of compare those to see which one you want one of those two to be 1R for position sizing. And what that
yeah,
will make is this that'll make this really routine. Like that'll destroy your concentration and focus if a
yeah,
routine intraday exit is giving you larger than 1R losses, that says the sizing on it is too large.
yeah. No, this really killed me.
Yeah,
Uh,
yeah. So the other thing that it'll do is by trading smaller, it will also give you a little more confidence to use. Again, we're still seeing that that PSAR flipping, even on the negative side, is better than the discretionary because you're getting chased out of those positions. Like this PSAR flip. I mean, if I just and this is Tesla naturally, so let me go find out what Tesla's numbers are. Tesla's R stat is
about 12 or 13.
$14.
It's been
Yeah,
increasing.
yeah, because it's he's been doing better and prices going up. So 183. Let's see. So here's the entry, and minus 14 is 183. So that's 1R risk. So now I could actually just say, look, I got a good entry on the PSAR flip on the 30 minute. And that's my actual, this is the exit that triggers me.
The execution stop. Yeah.
Yeah. So my execution stop, and then just say, leave it alone, exit. So you make from 197 to 210 or 211. That's $14. That would give you a 1R compared to this 1R. But your open risk at your worst exit would have been minus zero point 0.3. So that is actually very comfortable, and then you don't get into chasing your tail inside that space. If you see what I mean.
Yeah.
This is where that difference between execution R and position sizing R will just save your mind and your portfolio because you can position size with that as 1R. And then this exit up in here is really not surprising because that's the last place that it made a nice significant move from here to there, and
Mhm.
then a nice orderly move from there to here, and then an orderly. I mean, that's just like breathing. That's not even exaggerated volatility, and it's within kind of a Kata 2 framework. So this is actually should have been buying here, right?
Yeah. I think if I had the wider stop, I would feel comfortable buying there at the edge.
Yeah,
Friday afternoon.
Yeah,
After the gaps I had Friday morning, I wasn't comfortable buying anything in the afternoon.
exactly. So
Yeah,
I would use that lens of comparing the execution stop, which is geared towards the pattern, and then using the higher time frames R stat stop for position sizing, and the difference between those two levels really just leads to peace of mind because you know you're really only taking a minus zero point 0.3 R, and then you can then let the PSAR do what it's supposed to do, which is keep you in that trade.
yeah.
All right, so let's give
That
that a shot.
well, there's one more thing.
Yep.
If you have a chance, if you go back to the X, the U.S. Steel one, there were a few trades that I had earlier in the week before the
Okay.
we talked about the ones on the 17th,
Yeah.
but I had some on the 13th
Yep.
um,
Yeah,
and
I mean that's pretty good stuff right there.
yeah.
This is the let's see.
And again, I was using the R3 or the PSAR for a stop, so they had the same problem, but
Yeah.
in that case, I got
Yeah, so your entry
got
here and
luckier, unlucky instead of unlucky.
yeah, so this is so that's your PSAR exit, and then that's your PSAR entry, and then that would have been a PSAR exit at the end of the day, and then you could have actually gotten short from here or here, and then you're into that trade. This is the only again at the end of every day, and this is the difference between swing trading and day trading. So this is really orderly during the day, and then you get that gap down and then resume. And that sometimes that'll just happen, and that's why using the wider 1 hour stop allows you to you might have taken that as an exit because you don't know that it's not going to fail, but then that's a fraction of an R loss. And
Well,
in this
my
case, it
PSAR
probably
exit,
yeah.
my PSAR exit, I actually wait for the flip to occur.
Oh, okay.
Although I would, if it went too far below the dot, I might take a discretionary exit.
Yeah, what I the thing on that here's the last PSAR, the last couple PSAR dots in this move, and then the PSAR flip occurs on this bar. I don't mind uh, taking that exit like one PSAR dot before. So if that's the bar that's open, I take the PSAR dot before, and
Mhm.
I don't mind executing price on that one, especially if I'm in the position and I'm trying to hold that win. So PSAR minus one dot is a way, instead of waiting the extra bar for the flip to occur, and then you're already prices in this bar, that thing could already have been down here.
Yeah, I'm thinking two or three dots, but it depends how
Yeah,
wide the dots are.
yeah.
But exactly, I'm thinking the same way
The other
you're
place you
thinking.
see that is on is on the entries that you have this thing, the PSAR's coming down nicely, and this thing gapped down harshly, and then it doesn't fail further, and think, well, it's starting to go up now, and here's the orderly move. But sometimes you'll get price bars that just take off like this, and the PSAR's lagging, and then you miss this move in here. So what I like to do on that is sort of have a trailing entry from the previous dots, you know.
Yeah,
So if and I like to go back 2 dots. So if I was in this bar, my my entry would be either that dot or that dot. So I would just draw those lines. So if the next bar, instead of being a doji that went sideways, just took off, I could get one of those two entries while waiting for the RL10 to slowly take them out. So I find that little trailing 1 or 2 PSAR dot to be a reasonable way to not hate myself because I waited for the smoothed RL10. Because every one of those turning points, look, you get one of these large body price bars, and that's just a way to maintain some sanity. So there you are. Any questions on that?
No,
Make
no,
sense?
very
Okay.
clear. This is great stuff. I'll probably go back and listen to it again, but I think it has everything I needed to hear.
Okay. All right. I'm going to go ahead and shut her down then and get this posted. We're going to start. Next thing I got to do is write the welcome letter for the creativity guys. Um, we may be moving the Monday night session to Tuesday night, like at 7 p.m., so that my brother and Luke can be in on that one for the U.S. Aussies. But we'll go with 10 o'clock on Sundays for the Euros anyway, because that has a nice momentum to it. So right now I'm thinking it's going to be Sunday mornings and Tuesday evenings. So more to follow. And you're welcome to either one of those or both.
Thanks.
All right, that's all I got, guys. We're gonna we shall see you tomorrow.